In this video, I'm going to go through 8 different sources of passive income that I have. Together, these 8 sources bring me over $24,000 a month in passive income. Now, when people hear the word passive income, they always imagine this magical thing where you build once and it pays you forever. I hate to pop your bubble because there's no such thing as true passive income. Because as you will see later, even the most passive of passive income requires you to do some work every once in a while. So I'm rating every single source on 3 things. On a scale of 1 to 5, how easy it is for you to start, how much you can actually earn from it, and how passive it all really is. So let's not waste any time and let's jump right in. First up, bank interest. For me, I'm parking my money in DBS multiplier, where after fulfilling the salary crediting and credit card spending criteria, is paying me 1.8% in interest. Though, given how little money I have in my bank account, I usually only earn around $20 in a typical month. It ain't much, but it is still enough for me to buy a few plates of Chai Fan every month. Now, the reason I don't park my money in other high-interest savings accounts, despite them technically offering higher interest, that higher interest only kicks in when the monthly average balance is high. For example, if you have $75,000 or less, both UOB One's 1% interest and OCBC 360's 1.7% interest lose to DBS Multiplier's 1.8%. Not only that, the one unique feature of DBS Multiplier is that if you and your partner credit your salary into the joint accounts, it will count towards the total, thus helping to boost both you and your partner's interest. Besides that, since I'm a business owner, I also hold cash in my company's corporate bank accounts to pay for the running costs of the business, like my subscriptions, freelancers, and taxes. But rather than parking it all in the normal corporate accounts, which barely pays me any interest, I park the money in Wise instead. The nice thing about Wise, as compared to most other high-interest savings accounts, is that it doesn't require me to jump through hoops to earn the interest. All I gotta do is turn on the Wise interest feature and think I will start earning the interest. My SGD balance earns around 1.01%. So on a typical month, that only comes out to around $30. The US dollar balance is a lot better though, at around 3.39%, and that one pays me closer to $250 a month. Parking your money in a high-interest savings account is definitely the easiest way to earn passive income, and I think everyone should definitely do it. Otherwise, the inflation is going to eat away at your money. On a scale of 1 to 5, this gets a full 5 for how easy it is to start, because you are literally just opening a bank account. As for how much you can earn, that's a 1, because unless you are sitting on a huge pile of cash, you shouldn't expect much to come out of it. But for how passive it is, this is another 5. All you gotta do is choose a bank that gives you the highest interest, and the money just shows up every month. Watch this video to find out which is the best bank accounts for you. Next, while my day-to-day cash sits in a bank account, anything that I know I won't touch goes somewhere that gives me better interest. This is the money that I don't need today, but might need 1 to 5 years later. Stuff like my yearly insurance premiums, my kids' expenses later on, or even a family trip that I know is coming but not this year. For this, I'm using BigFundr. BigFundr is a platform which lets investors lend their money to property developers in Australia for tenures from anywhere between 6 to 12 months. And then in return, they earn around 5% in interest, which is paid out every month. And over the past 2 years, I've earned close to $2,000 while averaging around $80 in recent months. Now I know what you might be thinking. Lending my money to some property developer all the way in Australia? Sounds sketchy leh? That was my fear at first. But BigFundr is licensed and regulated right here in Singapore by the Monetary Authority of Singapore. So I'm not just handing my money over to some random developer and hoping for the best. But then, how is BigFundr able to give such high returns? Private property lending is actually the norm for small to mid-sized developers in Australia. According to a survey, roughly 72% say they fund their projects through private credit rather than the banks, since private credit can approve and release the funds a lot faster than the banks, and are also more willing to shape the loan around how the project actually runs. Because of that, the developer is willing to pay a higher rate, and that higher rate is where my 5% comes from. But of course, just because private lending is normal over there, that doesn't mean that every deal is a good one. That's why at BigFundr, every deal gets checked 3 times before it even shows up on the platform. First, an established Australian fund manager puts the loan together and prices the risk. And these are specialist real estate debt managers who are licensed by Australia's Financial Services Regulator. For example, Palace Capital, which has managed over $10 billion since 2016, and HMC Capital, which runs around $2.3 billion in property loans. After that, BigFundr's own team assesses every deal that comes through and looks at whether the borrower can actually pay it back, where the property is, what kind of development it is, and how long the loan runs for. And finally, its parent company, MaxiCash, runs one last independent check through its own credit committee. Though, this still doesn't guarantee that they will never get a bad deal. So if ever that happens, that's where BigFundr's 3 layers of protection comes in. Layer 1 is the first legal charge on the property, which makes BigFundr investors the senior first-in-line lender. This is so that in the event a borrower defaults, investors will get repaid before anyone else. On top of that, every loan is secured by real estate. So if a borrower can't repay, that property will get sold to cover what they owe. And to further minimize risk, the loan is typically capped at under 70% of the property's value. Then at layer 2, there's the borrower's personal guarantee. Now, this isn't just a pinky promise to pay back. It is a personal guarantee, plus a binding contract that puts the developer personally on the hook. And lastly, layer 3 is a buyback provision from the fund manager behind the deal. Now, of course, this is not a fixed deposit, and there's definitely risk to this. So it's definitely not for everyone. So if you want to know exactly what's protecting your money and whether it's actually safe, you can check out my video here, where I've done a full deep dive on the platform. Right now, BigFundr is running a limited time National Day special, where users can enjoy extra interest on top of the usual base rate. So if you're interested, you can sign up using my referral code here. On a scale of 1 to 5, I will give this a 4 for how easy it is to start. Signing up itself takes minutes, especially with their new app. But you have to do the initial research on how BigFundr works so that you really know what you are investing in. As for how much you can earn, I will give it a 3. The returns are higher as compared to other platforms, but you are taking on more but calculated risk to earn these returns. As for how passive it is, this one gets a 5. Unlike my SSB or my dividends, BigFundr actually pays me a monthly interest. So once you have picked up a deal that you are comfortable with, you don't even have to lift a finger. Next, besides parking my midterm savings into BigFundr, I'm also parking them into Singapore savings bonds. I bought many of these when the rates were at their peak. Across 5 different issues, they yield around 3.3%, which works out to about $2,400 a year, or roughly $200 a month. So even though I could get higher returns from BigFundr, the reason I park parts of my midterm savings into SSB is simply because of 2 things: diversification and flexibility. While BigFundr return is good, I think that it's just as important to diversify my money on other investments, just in case things go wrong, and in case it takes a while for my money to come back. SSB is also a lot more flexible. While BigFundr requires you to hold the investment till maturity, SSB lets you redeem the money and get it back the following month. This is especially useful if you ever need access to your money quickly. So on one hand, it is my midterm savings. On the other hand, it can also double up as my emergency funds if I ever need the money quickly. Unfortunately, you won't get that 3+% rate today, since bond yields have come down a lot since then. However, even at the current 2% average yield, I would still say that it is pretty decent, given that it offers both the flexibility of early redemption and 0 risk. Because of that, I would rate SSB a 5 for how easy it is to start. All you gotta do is just subscribe to one and you will start earning. As for how much you can earn, there's a 2, because while the returns are safe, they are small. And for how passive it is, there's a 5, since there's really nothing to maintain here. They'll just pay you every 6 months automatically over a period of 10 years. Moving on, dividends. Now, some of you might know me as someone who doesn't really focus in dividend stocks. However, I do have some stray Singapore bank stocks and REITs here and there. Together, these Singapore stocks currently pay me around $450 in dividends every year, which is ain't much, but it is still something. More interestingly, even though I mainly invest in US growth stocks, some of them do pay me dividends. So I guess technically, that makes them dividend stocks too. Across my brokers, 3 US stocks and ETFs pay me a little over $3,180 of dividends a year. But of course, I don't get to keep all of it, since the US government takes a 30% withholding tax on every dividend before it reaches me. So what actually lands into my accounts is closer to $2,250 a year, or about $2,900 after currency conversion. So if you combine both my SGD and USD dividends and spread them across the year, that works out to roughly $280 a month, which is actually not too bad. One thing most people find intimidating about dividend investing is the amounts you need before it pays anything meaningful. At a 4% yield, you will need around $30,000 just to get $100 a month. But here's what most people miss. The yield you buy at today isn't the yield that you will get in the future. That's because a good dividend company will tend to keep raising its dividends over time. And as that goes up, the yield on your initial invested amount would go up as well. Take my DBS shares for example. Right now, DBS pays around 4.4% in dividend yield. However, because I bought them a few years back at around $30 each, and because DBS has raised its dividend every year since I bought in, today I'm actually getting over 10% in yield. So as long as the company keeps growing its dividend, my yield would keep climbing, even if I never put in another single cent. All in all, on a scale of 1 to 5, I would rank dividends a 3 for how easy it is to start. That's because you can't just anyhow pick random stocks and pray that you pick the right one. There's a real risk of losing money if you pick wrongly. So you have to do your research. As for how much you can earn, there's a 3 as well, because you need to be patient and give it time for the dividends to grow into something meaningful. And for how passive it is, I will give it a 4. The dividends land whether you are watching or not, but you do still have to check that the company is doing well, whether it's through their earnings, announcements, or even competitor news. Next, my YouTube AdSense income. Every video that I've ever uploaded to YouTube becomes this tiny passive income machine, which pays me even years later, long after I've even forgotten I've made the thing. For example, this video which I've uploaded back in 2022, even though it has been almost 4 years, it still brings in around few cents every day. Now, the thing about AdSense income is that it is never stable. Some months it is higher, other months lower. But over the last 6 months, those ads have paid me around $2,400 a month. And as much as I want to make it sound like a true passive income machine, the truth is that the bulk of this AdSense income comes from videos that were recently uploaded, while everything else barely makes anything after that initial pump. So if you want to continue earning from it, you will need to keep creating videos. Otherwise, the whole thing will just collapse. And this is already considered decent. My AdSense is considered on the higher side simply because advertisers pay a lot more to reach a finance audience than they do for a vlog or a gaming channel. Those channels typically earn somewhere between $1 to $5 for every 1,000 views. Whereas here, you can see that I'm getting around $7 per 1,000 views. Because of that, I would rank YouTube AdSense for a 2 for how easy it is to start. It is brutal in the beginning, but if you can push past the initial learning phase, you will do better as time goes by. As for how much you can earn, I will rate it as a 3. $2,400 a month is real money, but that took me 6 years of uploading to get to. YouTube still pay peanuts, and it's worse if you're in a low-paying niche. As for how passive it is, I will rate it as a 2. It does pay me while I sleep, but only for as long as I keep uploading. The moment I stop, this number will start falling. That's why instead of relying on just my AdSense income, most online creators also build an affiliate income on top of that. Affiliate income is basically when someone signs up for something through my links and I get paid a commission for it. Over the last 6 months, that has averaged out to about $18,000 a month. I know this looks high, but this is only because I have spent the last 6 years building this up, one video at a time. While affiliate income sounds like good money, the one lesson I've learned over the years is that it's also incredibly risky, because when I put a link in the video, I'm putting my name on a company that I can't control. And if that company turns out bad later, that's on me, since I'm the one who talked about the platform in the first place. That's why I only share the stuff that I actually use, and that I genuinely think is worth it. Getting started on affiliate income is a 2 because you need years to build up your brand and trust before anyone else even bothers using your link. But once the audience exists, this becomes the biggest earner on my entire list. So for earnings, I will give it a 5. As for how passive it is though, that's only a 2, since most of those clicks come from whatever I've posted recently. So you will still need to keep uploading to keep the links alive. On top of that, you also have to keep checking that the companies that you watch for are still worth recommending because that might not stay true forever. Besides my affiliate income, I also sell digital products on the side. This is Coffee, where I put up the spreadsheets that I built while researching my own videos. Things like the best STI ETF, the best bond ETF, and the best Singapore REIT ETF. These are really just the spreadsheets that I already made for myself. Clean up a bit so that other people can use them too. And here's the interesting part. For most of these digital products, I just price them at $0 and let people download them for free or pay whatever they want. But some people do choose to throw in a few dollars here and there just to help support the channel. And for that, I'm forever grateful to them. Back then, when I was still actively updating this, it sold pretty steadily on its own, but I haven't touched the thing in a while now. As a result, you can see that the payout has grown from an average of $37 a month back then to close to $14 now. Making the digital product isn't hard, especially with AI tools nowadays. So I will put starting this at the 4. As for how much you can earn, mine is only a 1, because what comes back is literally a loose change. But that's also because I priced mine at $0 in the first place. But just imagine that if you created something that people actually want, like an expense spreadsheet or a retirement calculator, and actually charged money for it, that's when this stops being pocket money and starts becoming real money. As for how passive it is, I would say that it is a 3. The file does just sit there and keep selling on its own, which is about as passive as it gets. But you saw what happened the moment I stopped touching it. The payouts got cut by more than half, so the work never fully goes away. You still have to refresh it whenever the information gets outdated and keep pointing people to it. Last but not least, I have options income. The option strategy that I run on my portfolio is pretty straightforward. I sell cash secure puts, covered calls, as well as credit spreads, and typically it brings in around $3,000 a month. In the past, that used to be a lot higher, and that's because back then my entire portfolio was sitting on one stock, Tesla, and that stock was incredibly volatile. Because of that, I was able to collect some pretty fat premiums. I was also selling options pretty indiscriminately back then. I didn't really pay attention to the trends or any news. All I did was just keep selling because the premiums looked good. However, over time, I realized that this was a bad strategy as the stock could just suddenly shoot up and my cover cost would cap my gains. Because of that, nowadays I run it very differently. My money is spread across a lot more names and I don't sell on the stock unless the premiums make sense for the risk that I'm taking. I also actually look at what the stock is doing and what's coming up on the news, because that will determine whether it is worth selling right now. In terms of how easy it is to start, I will rank this as a 1. This is the hardest one on the entire list to get started, because you need to properly understand how options work before you sell a first contract, and you need real capital sitting there to back it up. As for the amounts that you can earn, I will rate this as a 4. The money is genuinely there, and options can really pay well when you get it right. But you need a decent amount of capital behind you before the premiums end up to anything meaningful. And every bit of that premium comes with risk attached. And for how passive it is, this one is a 1, which makes it the least passive thing on my entire list. You have to constantly scan for opportunities, work out whether the premiums is worth the risk, and also decide when to take the profits or cut the loss. If I stop showing up, this income will stop immediately. So there you have it. Those are the 8 income sources that I earn from. Some of them are easy to earn, others are harder. But if there's anything to take away from this video, it's that you should start building at least one stream of your own, so that your salary isn't the only thing paying you. So which of these surprised you the most? Drop it in the comments down below. If you found this useful, hit the like and subscribe. I post new videos every week, and I will see you in the next one.